Howdy, everybody. Welcome to the Liberty Call for Thursday, March 10th, 2022. I hope everybody's having a great day out there. It's a little gloomy here in Colorado. The sun is trying to come back out. I think the last of the snow is going to come through today. So either I get to clear the driveway with the snowblower one last time of this season, either this afternoon or tomorrow morning. So I've got that in my future. So y'all say a prayer for me and hope I don't have a heart attack out there in the, what is the temperature right now? 13 degrees. It's a balmy 13 in Larkspur, Colorado. So, all righty. Well, like I said, I hope everybody's having a great day. Kind of a day in the markets, mostly down, but not too bad. I don't see anything down more than a percent. So, after yesterday's bounce back from Tuesday's sell-off, it's just the volatility is back and forth. But one thing I can say is at some point, better days will be ahead of us. So, just stay positive. That's all I can really say. All right. If it's your first time watching, please click on the subscribe button or the like button if you're on Facebook. Also share with friends and family. I would greatly appreciate it. Let's go ahead and dive in and see how the markets did today. All right. Let's see here. Dow Jones closed down 0.34% to 33,174. The S&P 500 was down 0.46, closing at 42.58. NASDAQ down 0.95, closing at 13,129. Small caps were down 0.17. The VIX was also down 6.84%, closing at 30.23. So that is a good sign. As you know, I talk a lot about the VIX. And, anytime it's above 30 is a real danger number for me. 20 to 30 is kind of that yellow light, proceed with caution. So you can see we've been above 30 for since about the end of February. So it has not been, the volatility has not been real good of late, but it's certainly not unexpected with everything that's going on in the world. But again, I'm keeping an eye on it and making changes accordingly. So, all right. Looks like the Canadian market was up almost 0.5%, but everything else across the Americas and Western Europe, red. Lots of 2% and 3% in the France and the Euro stocks, also in the Netherlands. This one took a beating. Italy was down 4% today. Let's see, Russia markets are still closed. That's probably not surprising with the sanctions and everything that's going on over there. Let's see, the first up market I see is Budapest, Hungary. It was up 3% today. Then there's more reds until we get down to the Asian markets. Everything from the Nike was up almost 4%. Down to the Hang Seng was up 1.27, and nothing but greens down here. So it looks like the trading day for March 10th started out in green, and slowly as we got to Eastern and Western Europe, we had more down markets, and then here in the U.S. we were I don't want to say flat, but certainly was not nothing to get too worried about right now. So let's take a look and see how commodities are doing, because they have been all over the place. Gold and silver have been doing really good of late. Gold looks like it was up about 0.25% today. Last trade was 1996. Silver was up about 0.5% today, 0.54. Last trade looks like it's at 25,922. All right. The rest of the commodities we really care about, oil and gas. Oil was down, let's see, WTI was down 2.89%. Brent crude was down 1.91. So a little relief there. We'll see what happens with the oil markets. And actually, I have some articles I'm going to share tomorrow on the weekly wrap up that goes through, what's going on with the oil companies here. I know if you watch any of the national news, you probably saw Jen Psaki say something about there's 9,000 leases that are already approved, but Then I'm hearing that there needs to be permits in addition to the leases. So, I mean, what I think is probably, there's a little bit of slow walking, I guess is the term people would use. Yes, there are approvals for oil and gas drilling, but there's still more that has to be done to actually get the process pushed through. Everything from EPA analysis to wildlife analysis. I mean, there's just a bunch of stuff that has to be done when you're drilling for oil. So, all right, well, let's go ahead and take a look at this wrap up of the market for today. S&P off lows, but Russia-Ukraine conflict red hot inflation way. It's written by Yassine Ibrahim from Investing. The S&P 500 moved off lows Thursday, but remained under pressure as hopes of a diplomatic solution to the Russia-Ukraine conflict suffered a setback, while inflation surged to fresh 40-year highs. Ukraine's Foreign Minister Dmytro Kuleba said there was no progress on discussions concerning a ceasefire and said that demands from his Russian counterpart, Sergei Lavrov, would amount to a surrender for Ukraine, something the country isn't prepared to do. Russia isn't in a position at this point to establish a ceasefire. They seek a surrender from Ukraine. That is not what they're going to get, Kuleba said following a sit-down with Russia's Lavrov. Many had hoped that Ukraine's softer stance on seeking to join the NATO military alliance in the days leading up to the meeting would pave the path towards a diplomatic resolution. The lack of a breakthrough renewed fears that prices for key commodities, including oil, gas, wheat, and corn, key exports from Russia and Ukraine, will remain elevated and keep inflation higher for longer. The Consumer Price Index rose 0.8% in February, pushing inflation for the year through February to 7.9%, the hottest annual increase since January of 1982. The risk is that the inflation we are enduring now could become more entrenched as it did in the 1970s. That's why the Fed is so wedded to raising rates starting in March, said Diane Swank, chief economist at Grant Thornton. Technology fell nearly 3% as investors fled big tech, though Amazon bucked the trend after announcing a 10 billion share buyback program and a 20-for-1 stock split. Falling semiconductor stocks also weighed on the tech sector on concerns that ongoing Russia-Ukraine conflict will exacerbate supply problems for chip companies. Financials paired their gains from a day earlier as banks were pressured by ongoing flattening in the yield curve in the wake of growing worries that red-hot inflation and slowing economic growth increase the risk of recession. The headwinds for banks is clearly the Russia exposure, but it's also the flattening in the yield curve. Melissa Brown, managing director of applied research at Contigo, an index and analytics provider, said in an interview with investing.com on Thursday, higher rates are fine for banks as long as short-term rates are lower. But if that's not the case, that's going to hurt banks. Energy stocks was one of the few sectors in the green, even as oil prices erased their intraday gains. So again, kind of a mixed day. Some things did well, some things not. I think everyone's just kind of recalibrating where they want to have their portfolios or where they think the market is headed, and they're trying to get out of the way of any falling knives. All right, next article: households squeezed as U.S. consumer prices accelerate. More pain coming. It's written by Lucia Mutakani from Reuters. U.S. consumer prices surged in February, forcing Americans to dig deeper to pay for food, rent, gasoline, and inflation is poised to accelerate even further as Russia's war against Ukraine drives up the costs of crude oil and other commodities. The broad rise in prices reported by the Labor Department on Thursday led to the largest annual increase in inflation in 40 years. I feel like I keep saying that over and over and over again. It's like every month it's the highest inflation in 40 years. I mean, at some point it's going to come back down, but I think the Fed's going to have to do a little more than a 0.5 or 0.25% interest rate increase to do that. All right, let me get back in here. Inflation was already haunting the economy before Russia's invasion of Ukraine on February 24th and could further erode President Joe Biden's popularity. I think half the country hates him already. So, anyways, the Federal Reserve is expected to start raising interest rates next Wednesday, with inflation nearly 4 times the central bank's 2% target. Economists are expecting as many as 7 rate hikes this year. Lower income households bear the brunt of high inflation as they spend more of their income on food and gasoline. Consumers' shock at rapidly rising gas prices at the pump will continue to put pressure on the Fed and policymakers to do something, anything, to slow down the speed at which prices everywhere are moving higher, said Chris Zaccarelli, Chief Investment Officer at Independent Advisors Alliance in Charlotte, North Carolina. The Consumer Price Index increased 0.8 last month after gaining 0.6 in January. A 6.6 rebound in gasoline prices accounted for almost a third of the increase in the CPI. Gasoline prices had declined 0.8% in January. Food prices jumped 1% with the cost of food consumed at home soaring 1.4%. Prices for fruit and vegetables increased by the most since March of 2010, while the rise in the cost of dairy and related products was the largest in nearly 11 years. In the 12 months through February, the CPI shot up 7.9%, the biggest year-on-year increase since January of 82. That followed a 7.5% jump in January, which was the 5th straight month of annual CPI readings north of 6%. February's increase of the CPI was in line with economists' expectations. Last month's CPI data does not fully capture the spike in oil prices following the outbreak of the war in Ukraine. Prices shot up more than 30%, with global benchmark Brent hitting a 2008 high at $139 a barrel before retreating to trade around $112 a barrel on Thursday. The United States and its allies have imposed harsh sanctions on Moscow, with Biden on Tuesday banning imports of Russian oil into the United States. Russia is the world's second largest crude oil exporter. U.S. gasoline prices are averaging a record $4.31.8 per gallon, compared with $3.46.9 a month ago, AAA data showed. Biden on Thursday acknowledged that the hardships Americans were facing from skyrocketing prices, but blamed Russian President Vladimir Putin's actions. So let me stop there. While I do agree that the Russia's actions have led to the short-term spike in gasoline prices, the inflation that we're seeing right now was actually caused 2 years ago by the increase or the inflation of the currency with the stimulus spending and the bailouts and everything that was going on 2 summers ago. So to say that this is all Russia's fault, it's not. Are they bad actors? Certainly. Is Ukraine a bad actor? Absolutely. Are most of the governments of the world bad actors? Yes. So it's more of a matter of pointing the finger at something that is a problem right now. But in the grand scheme of things, I mean, we have enough oil here in the United States that if we were actually pumping at full capacity and we didn't have as many regulations and rules and things around getting the oil out of the ground, we could probably have tougher oil. And again, I have some articles I'm going to cover tomorrow that will go into greater detail on that. As I said from the start, there will be costs. There will be costs at home as we impose crippling sanctions in response to Putin's unprovoked war. But Americans can know this: the costs we are imposing on Putin and his cronies are far more devastating than the costs we are facing, Biden said in a statement. Soaring inflation is wiping out gains. Inflation-adjusted average hourly earnings fell 2.6% on a year-on-year basis in February. The Labor Department said Moody's Analytics estimates the inflation at February levels was costing the average household $296.45 per month, up from $276 in January. Economists, let me add that back. Oops, there we go. Economists expect the annual CPI rate will peak at above 8% in March or April and start to slow in the following months as high readings from last spring's drop out of the calculation. Stocks on Wall Street were lower. The dollar gained versus a basket of currencies, and U.S. Treasury yields rose. Inflation was ignited by a shift in spending to goods from services during the COVID-19 pandemic and trillions of dollars in relief from the government. The resulting surge in demand ran against capacity constraints as the spread of the coronavirus pushed millions of workers out of the labor market, making it harder to move raw materials to factories and finished goods to consumers. Excluding the volatile food and energy components, the CPI increased 0.5% last month after advancing 0.6% in January. Well, I mean, But food and energy, those two things nobody ever uses. I mean, crazy. A 0.5% rise in the cost of shelter, like rental accommodation, as well as hotel and motel rooms, accounted for more than 40% of the increase in the so-called core CPI. The cost of rent jumped 0.6%, the most since March of 2005. Rental costs are sticky and will keep core CPI hot. Due to the way rents are sampled in the CPI, resampling every 6 months, the index tends to lag other indicators such as the Zillow Observed Rent Index, suggesting CPI rents will likely continue to rise strongly for a while yet, said Daniel Vernaza, chief international economist at UniCredit in London. Consumers paid more for household furnishings and operations, motor vehicle insurance, as well as clothing and personal care. Airline fares soared 5.2% as sharply declining coronavirus infections boosted demand for travel. But prices of new motor vehicles rose modestly while used cars and trucks fell, suggesting some easing in pent-up demand. Motor vehicles were one of the main drivers of inflation because of the global semiconductor shortage. In the final 12 months of February, the core CPI vaulted 6.4%, the largest year-on-year gain since August of '82, after increasing 6% in January. Despite high inflation, tighter monetary policy, and the conflict in Ukraine, a recession is not expected. I don't know about that. Demand for labor is strong, with a near record 11.3 million job openings at the end of January. Households are sitting on about 2.6 trillion in excess savings. The cost to consumers is high, said Ryan Sweet, a senior economist at Moody's Analytics. However, there are also reasons to be optimistic that consumers can weather a temporary spike in gasoline prices, as households' balance sheets in aggregate are in great shape. Gasoline spending as a share of total nominal consumption is low. Though a separate report from the Labor Department showed initial claims for state unemployment benefits increased 11,000 to a seasonally adjusted 227 for the week ending March 5th. They remained at levels consistent with a tight labor market. So I mean, again, some of the things in here, as far as inflation, some good news, that the used vehicle market is seeing a little bit of a retraction in costs or in prices. So maybe that's starting to slow down. I know a lot of folks would rather buy a new vehicle. Well, there's always going to be people who would rather buy a used vehicle just because they don't want to suffer the depreciation. However, there are folks who, they like to start off with something new. And if they can get a new vehicle for a very similar price, they're typically going to do it. But again, everyone has their own preferences there. So, but, like I said, earlier, the inflation we're seeing right now, a lot of it is from 2 years ago. I mean, the stuff we're doing today is going to take a while to go through the business cycle and, see it at the, end point of the of the production line. So whether or not you're buying widgets or remote controls or whatever, it's going to take time for the inflated costs today to see it at the end point. So, all right. Last article I got here has to do with jobless claims. Jobless claims, another 227 individuals filed, or 1,000 individuals filed new claims last week. Applications, and this was written by Alexandra Semenova. This comes from Yahoo Finance. Applications for unemployment insurance inched up higher than expected in the latest weekly data, but extended a broader downward trend after surging COVID-19 infections earlier this winter briefly disrupted the labor market's recovery to start the year. I like how they always talk about the COVID-19 because, again, the excuse they were using in January for the higher numbers in unemployment was that, people were out of work because of COVID-19. I just don't see that. I've been off sick, from work before, and I never once filed for unemployment. So it just, yes, could there be someone who got laid off because this was the last straw and, this was when they got terminated? Sure. But I just don't see, especially if a company is, having a hard time retaining their employees, they're not just going to let somebody go simply because, they're out sick for a week, especially if they're trying to retain people. So anyways, initial jobless claims week ended March 5th at 227 jobless claims versus 217 expected, and an upward revision for the prior week to 216,000. Continuing jobless claims for last week came in at 1.494 million versus a forecast of 1.450. So it's about 44,000 over forecast. And last week's was revised down to, revised down to 1.469 million for the previous week. The previous report reflected initial jobless claims of 215,000 filed in the final week of February, making a 2-month low and a read better than economists had anticipated. The figures also reached the lowest since the week of December 31st, when new weekly claims totaled 207,000. Economists surveyed by Bloomberg expected the latest reading to be at 217,000. Meanwhile, Bank of America forecasted initial jobless claims are likely to fall to 210,000 in the week ahead, or ending March 5th. All right. So the let's see. Filings for unemployment insurance have mostly fallen after a temporary surge mid-January to a print of nearly 300,000, following a rush of U.S. workers applying for benefits amid disruptions from the Omicron coronavirus variant and workforce after the seasonal hiring increase at the end of 2021. Although COVID's impact on the labor market may have appeared to ease, the economic toll the war in Eastern Europe may have remains unclear. The recent shocking surge in gasoline prices, if sustained, will serve as a costly tax on consumers, Hamrick added. How much that slows economic momentum in the coming days, weeks, and beyond is difficult to precisely gauge and predict at this point. Rubella Faruqi, chief U.S. economist at High Frequency Economics, predicted in the note that rapidly improving labor market conditions should continue for now, in quotes. The Labor Department's broader gauge of the U.S. workforce, the February jobs report out last week, again, surprise to the upside. The U.S. economy added back 678,000 jobs last month, the most since July of 2021, as employment accelerated, even in the already tight labor market. At the moment, financial market turbulence and coming slowdown in Europe's economy after Russia invaded Ukraine is having no spillover effect in the U.S., Forward Bonds chief economist Christopher Rupke said in the note. While an improving labor market is good for U.S. households, the trend again reverts attention back to the Federal Reserve. Widespread job openings have made room for significant leverage for workers, driving wage gains higher and further elevating inflationary pressures. Average hourly earnings decelerated in February, but rose 5.1% on a year-over-year basis. Labor demand is very strong, and while the Labor Department participation has ticked up, labor supply remains subdued. Federal Reserve Chair Jerome Powell said in the congressional testimony last week. As a result, employers are having difficulties filling job openings. An unprecedented number of workers are quitting to take new jobs, and wages are rising at the fastest pace in many years. Powell added that the fellow central bank policymakers would agree the current labor situation is consistent with maximum employment, and as a result, he would support a quarter percentage point interest rate hike after the Fed's next meeting concludes on March 16th. So, good news. And, well, I guess it's sort of good news. I mean, there are a lot of jobs out there that are open. And, unfortunately, I think it's more of a skills gap at this point. The people that are unemployed do not have the skills to fill a lot of those jobs. Or it's, they're the jobs at the bottom of the food pyramid essentially, and no one really wants them. So there will come a breaking point where either people will reduce their expectations or employers will raise their wages. It'll go one way or the other. So I mean, it's just the way the economics works. When someone values the money more than they value their time, they'll go out and work. But it's going to be a slow process, unfortunately. So. All right. Well, that's everything I had for today. So I hope everyone has a wonderful Thursday evening, and I'll be back tomorrow with the weekly wrap up and see what's been going on in the world over the last 24 hours. So hope everyone has a great evening, and I'll talk to you then.